one thing caught my eye in your earnings release, and that is the kind of churn or attrition you've seen in your mortgage portfolio. And it just, sort of the question popped in my head, simple maybe, but this in a very low interest rate scenario, do NBFCs still have an incredible competitive edge?
That's a good question, and that's why the answer to that is, what is the differentiation that an NBFC brings to a particular line of business versus a bank? If it's only going to be interest rate arbitrage, then when banks get into those lines of business, it will get really tough for an NBFC. Now look at it this way: HDFC Limited is an NBFC, but it is the largest home financier competing with banks since inception. So it's not that you can't build that differentiation, but there are enough NBFCs that don't focus on building the differentiation, that don't focus on that customer service, they don't focus on the uniqueness of their product or service. And they are the ones that will get hit, because as is obvious in the last few months, banks are not able to extend credit to most of the other lines of business. So as a result, they're going after some of the retail lines, and they're able to cut rates more than most other NBFCs.
So you've had to take, or you said you will be taking competitive pricing action. So it's a race to the bottom right now.
No, not really. In our case, in none of our lines of business are we the lowest interest rate service provider. But it does not mean that you don't stay within the range of interest rates at which a good quality customer will come to you. Otherwise, you'll get adverse selection. So when we see rates falling, we will also cut we'll also partly cut our rate. But on the other hand, there are a lot more intelligent things that you can do to ensure that your book still stays not only of good quality and reasonably growing, but profitable as well. And I can't let out all those secrets.
All right. Bad loans, GNPA or gross national NPA ratio would have been 2.86. This is the pro forma numbers if the Supreme Court stay had been lifted, versus 1.34 in the preceding quarter. That's an almost doubling of bad loans. Does it get much worse from here on, Sanjiv?
Hopefully not. As long as the pandemic does not throw up any nasty surprises, I would expect the worst to be behind us. As a company, we are very driven by the numbers that we see, and that's why we are very transparent in sharing those numbers so that our investors can make their own calls. But as of now, things are looking better than what we had expected. We were very conservative early on. We cut growth. We upped our collection efforts. We gave moratoriums to customers that wanted it. The good thing that we are seeing is that other than a small segment of customers who went through a tough period, and they are the ones that are contributing to the higher losses, but many others have started coming back and paying. And new loans that we have given, so the book that didn't exist prior to COVID, that book is operating at the same quality level as the pre-COVID book, which means inherently we are still in a country where people want to pay, they are honest. Some of them have gone through a terrible time, and we are part of the system that will have to absorb some of those losses. Like the government is taking some, the individual is taking some, the financial services system has to take the rest. But incrementally, as of now, things are looking better.
So you're peaking out at 2.83 or 3% or so, nothing beyond that?
That's what it looks like as of now.
Okay, fair enough. I noticed that your consolidated assets under management or AUM levels are just about back to the December 2019 levels. You're roughly at 1.43 versus 1.45 lakh crore. From here on, what kind of growth do you intend to pursue? Because you had consciously cut back on growth and cut back on lending over the last 12 months or so. Even pre-COVID, you were cutting back on lending. If I remember correctly, the last Davos conversation we had around the same time last year. So here on, what kind of growth do you think you might be able to chase in the next 6 to 12 months?
Little early to say that right now. I think by the end of Q4, we should be in a much better position to be able to talk of growth for the next year. Right now, we are still in a situation where we are coming close to normal. As I told you, first quarter, we should be at a normalized level of volume compared to pre-COVID times. So as a guess right now, there's still too many moving parts, but hopefully by the end of Q4, we should have a better sense.
Okay. A quick last couple of questions on the regulatory framework. Since we last spoke, there have been two interesting RBI papers. one an internal working group paper that recommended the opening up of the banking license space to large business groups. If a business group like yours is interested, that would benefit you if it were to become reality. And the second is a discussion paper that the RBI put out more recently on NBFC regulation. Not too many surprises there, except that some of the things we've discussed in the past are not necessarily in the paper. So if you could share your views on both, that would be great.
So the second one, as far as the regulatory supervision side, from what I've seen of this paper, it is quite pragmatic and balanced. There are certain details on formulae based on that classification, which when it comes out, we will have a better sense. But directionally is the correct thing to do. Over the last decade, a large number of NBFCs today are much bigger than banks, and yet were operating with very light regulatory supervision. That needs to change. However, we must also keep in mind that just putting the rules are not good enough. Somebody needs to be supervising. Otherwise, we should not have seen the blow-ups, not only in NBFCs, but even in banks that have happened in the last couple of years. So there is a responsibility to the regulator as well. And I'm sure they understand that, and the last couple of years has shown that weakness. But this additional supervision was required for the large NBFCs. I think when you're small and medium, there should be a lot more flexibility so that it allows you to grow, it allows you to be innovative. Once you come to a particular size where you become important to the larger financial system, this is something that was required to be done. As far as the first, the internal working group paper is concerned, because it's very much something work in progress, that's why I've consciously not talked about it. Let's wait for the final rules to come out. And irrespective of what Bajaj does, I'm firmly of this belief that in our country, if we really have to get that 10% plus GDP growth rate, we need 2 to 3 new banks every couple of years for the next decade. And only then will we really take financial services to the masses. And we have such a good example in insurance. 2000, when insurance opened up to the private sector, the total size of the government of LIC and then of the government non-life insurers was 10,000 crores each. So it was a 20,000 crore industry. It is a 8 lakh crore industry today with over 50 companies, with significant increase in penetration and density of insurance. And we still have so much to do. We are still nowhere near where we need to be in terms of insurance penetration. So the opportunity is still great. A lot of those licenses went to business houses. Some got into trouble. That's the nature of business. You take risk. If there is fraud, please address it separately. Otherwise, encourage businesses to invest, to grow, accept failures, clean them out fast so that businesses can reinvent themselves and move ahead. And we have seen that on the insurance side. Where on the insurance side, the regulator even allows insurance companies within the group, those that are part of a group, to lend up to 5% of their assets within the group. I don't think anybody has lent even more than 1%. And this whole cry that you hear that business houses will misuse the licenses, don't give it to the ones who you think will misuse the licenses. And do you think those guys who will misuse the licenses will misuse their own licenses? There are enough other banks for them to misuse, and there are enough examples of that. I think we have to move away from crying wolf to deciding what we need to do for this country. Let's focus on that and act on that.
Okay, so do these papers in combination change your view on whether Bajaj would be interested? I'm not asking whether you're applying for a bank license or you will apply, depending on what happens. But does it change your view on your interest in wanting to become a bank?
As far as the NBFC paper is concerned, it makes us a lot more comfortable that NBFCs like us that actually already meet most of the requirements of the new supervision, we already have those practices in place, will now be on a level playing field with many others that are not. So we get even stronger as an NBFC. As far as the bank is concerned, let the final rules come out, then we'll see.
One of the things the NBFC framework has, while it doesn't impose, I think from what I understand, any substantive new capital requirements on large NBFCs like you, it also doesn't discuss any kind of liquidity backstop by the regulator. And one of the things we've discussed over the last 2 years that we've seen NBFCs in trouble, you've said that maybe the RBI should make provision for such a backstop, at least for the top 10 largest NBFCs in the country. This paper doesn't address that, does it?
Correct. So this has been more on the supervision side. The good thing is that through this pandemic, as you know, RBI opened up a direct line, liquidity line to NBFCs. This was done after nearly a decade. It was last done, I think, in January 2009, after the last big financial crisis. It shows that, at least it shows now that RBI is willing to come in and help when externalities require that. Not when an individual NBFC is failing because of a poorly executed business plan or a poor business plan, but when the system is under attack because of an external driver. So that's a good point. Now, from a general liquidity point of view, here I think what RBI should seriously look at for the large NBFCs is provide them a liquidity window for which they need some security. That's why you have SLR with banks. Today, those NBFCs like us that have a fixed deposit license anyway have some money kept aside in SLR. But if those who want to access this additional window require an SLR requirement there, if nobody accesses it, you don't lose anything. And those that put in some money into SLR and use this window are the ones that are that much more robust, creating a robust financial services system. So I hope I don't know whether we'll see that or not, but yes, that is one of the points I hope comes up at some point of time.